Hello and welcome to Livewire's alternative series for 2025. My name is Chris Conway. Today I am sitting down with Shawn Lese from Nuveen. He's the Chief Investment Officer and Head of Funds Management for Nuveen Real Estate. He's going to be talking to us about global real estate opportunities. Shawn, thank you so much for sitting down with Livewire today.
Hey, it's a pleasure to be here. Thank you for having me.
Aussie investors, we're pretty familiar with private real estate here at home, but less so globally. So Shawn, can you just take us through why a global approach is important, particularly right now?
Well, the global approach is going to give you diversification. It's going to give you something different in different geographies at different times. For example, you could have values, as sort of has happened recently here, where they've been declining. But you could have values that have a much stronger basis someplace else in the world, right? And so that gives you the opportunity to really kind of pick and choose and really look for your best risk-adjusted returns.
After a couple of years of correcting, values seem to be stabilising, even rebounding across most regions. So how are you interpreting this inflection point, and then what's the signal for investors to maybe put some capital to work?
Yeah, I think we're probably past the point where I can, equivocate on the topic. I think we're there. I think we're at the turning point. We've hit the turning point. We've had 3 quarters, for example, in the United States, we've had 3 quarters of positive valuation increases already, 4 quarters of total returns in the positive area. And when we look historically, with that kind of a dynamic in mind, we see a nice runway for positive returns going forward. So when I think about and I look at the dynamics that exist in the capital markets, including, interest rates with maybe just a marginally downward biased area and the valuation changes that have already happened, I feel pretty comfortable feeling like we can step back in and we don't need to be worried about the valuation fluctuations happening as a result of capital markets changes.
Right. Across regions, subsectors like medical, office, necessity retail and logistics, so they've been showing resilience. So Shawn, which areas do you believe will offer the most compelling opportunities over the next, let's call it 3 to 5 years?
One could look at medical office buildings, medical outpatient buildings, for example. And even if you have some softness in the fundamental economy, you're still going to have to get healthcare services, right? So whether the economy's booming or the economy's crashing, if you break your foot, you're going to need to go and get an MRI or an X-ray. And so you've got like a nice acyclical component to the medical outpatient buildings. You can also buy those properties at pretty attractive capitalization rates. So you're getting a nice yield on it. And then in a lot of parts of the world, you've got this aging baby boomer population. Well, in the United States, we call them the baby boomers, but you've got aging populations everywhere. And what that generally equates to is the need for more and more and more healthcare services to be delivered, and you need to do that as cheaply as you can. Those are generally done through outpatient buildings. If you were to ask me what's maybe number 2 on my list, I'd probably go with the grocery-anchored shopping centers, right? Needs-based. And again, that asset class was kind of all tarred with that negative retail brush. And as a result, valuations have fallen to the point where, you can't even come close to replacing a grocery-anchored shopping center to build a new one relative to what it costs for you to buy one, out in the market right now. So you're talking 40% discounts to replacement cost. No new supply is coming in that space for the foreseeable future, and yet the demand remains pretty robust. And that's also an area where if you do have any kind of softness in the economy, it's going to remain really resilient because people are going to need to eat. People may actually go to the grocery store more in a softer type of an economy.
Yeah, that's definitely a trend here in Australia, that convenience retail. So it's interesting that it's in other regions as well. Shawn, let's talk about the 3 Ds. So decarbonisation, demographics, digitalisation. They're reshaping the demand for real estate. So how will these forces change the shape of cities in the future?
Well, I think the first thing to think about is the demographics and what's happening with, again, we talked about the aging populations, but also just the migratory patterns that are happening and movements to different cities and the demographic growth that you see. And, those cities that can create a livable environment and have a high quality of life, those cities that have regulatory regimes that are friendly to businesses, and maybe some of those cities as well that have are in jurisdictions with more benign tax situations, are going to be attracting people. And I think you can see growth there You do have to be careful, though, in those circumstances. You can be enthusiastic about the population growing and generally increasing demand for all types of real estate, but you do need to be careful as well about the oversupply situation, right? So we've seen that particularly, in a lot of the more attractive markets in the United States in the Sun Belt, where, there's a lot of supply of multifamily, for example, in your Austins and your Nashvilles. But that's a dynamic where I think that's largely behind us. But generally speaking, I think those can be some pretty attractive places.
Shawn, we've seen banks pulling back from direct real estate lending. So how does that help and shape the opportunity set for Nuveen and then, of course, your investors as well?
Yeah, well, they definitely pulled back, and you can go back 3 years at this point. So really, when the interest rate increases, almost as a global phenomenon, happened, but certainly in the United States, it was basically in June 2022 when the Fed raised the short-term rates by 75 basis points, and Jay Powell came out with a very hawkish, perspective on what's coming down the road. Really, banks at that point pulled back and said, "Hey, we don't know where valuations are going. We don't understand where interest rates are going. We're going to step back from the market." That was the case for the back half of 2022, all of 2023, and probably the first half of 2024. And then what happened in 2024, mid-2024, a lot of those same banks that said, "Hey, we're kind of no longer involved," we got affirmative calls from those banks basically saying, "Hey, remember what we told you back in 2022? Well, scratch that, right? We are a bank after all, and we're looking at our net interest margins, and we're realizing we need to lend, right? And real estate valuations have fallen. We feel pretty secure about getting back in at this point in time." And so the banks were actually, I think, the one of the catalysts that allowed for the capital markets to kind of recover, and that goes back a year ago. So they told us we will be investing and lending against the direct properties that you guys are buying, so let us know if that's the case. We're there for you if you want to put in place revolving loans over a pool of assets or maybe for a fund itself. But interestingly, what they've also done is they've returned to the market and provided what we call back leverage for the alternative lenders. So, a lot of the real estate managers have debt funds. And really, during that 2-year period when the banks weren't present, it was those alternative lenders that were able to step up. Those alternative lenders are, promising their investors a 9, a 10, 11% IRR. But in order to achieve that, they need to lever those positions. So they might make a whole loan from 0 to 70 on a particular property, LTV, yep. And then they may take that and drop it into a warehouse line, or they may do an A-note, B-note structure. And the banks are back providing that back leverage. And so, if you've got $1 billion debt fund, for example, you now have $4 billion of lending capacity because the banks are back. As a result of a lot of this capital being available, the other thing that's really great if you're a real estate investor is the spreads are coming back in. So, you combine a combination of hopefully some downward sloping yield curves, right, either on the floating rate basis or fixed, with tighter spreads, that's going to be very good for real estate.
No doubt. Shawn, Europe has been described as the world's best diversifier, and it seems the US is entering a new cycle. So how should investors be thinking about regional allocations?
Yeah, well, regional allocations are very important, and certainly Europe has come back on the map this year as a very attractive place to be deploying capital, right? So first of all, if you think back to the beginning of the year, it was attractive in the sense that, well, valuations had fallen, say, 25% on average versus the United States, which had fallen 20%, right? So both of those, all right, good entry points, right? Feels pretty good. But the real problem, call it back to the beginning of this year with Europe, was more around political risk, but also, hey, where's the growth going to come from? Right, and so you and the political risk that I'm talking about, really revolved around the EU and the viability of the EU. If you think back, right, go back, to we had a Brexit. Yep. If Le Pen had won, we would have had a Frexit. If the AFD had won, who knows if we would have had a Germexit?
Yep.
But you've already got, in Italy and in Holland, you've already got, more of a populist type of more of a right-wing government, which ran on a mandate of, let's get out of the EU, let's stop delegating all this power to Brussels. We don't know if we trust them. And I feel like that's reversed itself, ironically, thanks to Donald Trump, because I think as a result of his presence, the EU came together and maybe recognized a lot of that populist tendency, every man for himself sort of tendency was, reflected in sort of how Donald Trump won and what his message was. And I think that they probably didn't want to, see themselves in that light. And I feel like the EU is a much more cohesive group right now. And there's that other element I mentioned too, which was, we would sit back and ask ourselves like, okay, great, valuations have fallen, but where's that growth going to come from? And, the governments over there have done a number of things to really stimulate. So whether it's Germany on defense and other types of investments into the economy, digging into their pockets and borrowing money and to stimulate the economy, or even just working on lower interest rates as well, you can now see a path to some growth. So with that political stability issue settled, and a real view of let's stand on our own and let's get the economy going. I'm pretty enthusiastic about Europe as an investment location right now.
Yeah. Shawn, last one for today. For
Yeah.
wholesale investors in Australia who might be underweight global real estate, what role can the fund play in a portfolio?
Well, real estate overall is it's just a great diversifier, right? There's no question, because there's very low correlation to a lot of different asset classes, right? But real estate overall, right, it's going to give you income, it's going to give you the potential for capital appreciation, right? So a total return in the zone of 8 to 10% over a cycle, right? But that diversification element is something that I think is really the key. This fund specifically is designed in a way that, you can think of it almost as sort of Nuveen's best ideas fund. So we've got, boots on the ground around the world, 30 offices. We've got $140 billion of assets under management. We're the 5th largest real estate investment manager, right? We invest in all of the different real estate sectors. We invest in different geographies around the world. We invest in debt, and we invest on the equity side. And so this fund really represents sort of our best ideas sort of put into work for the benefit of our clients.
No doubt. Shawn, thank you so much for sitting down with Livewire. We appreciate you taking us through that.
My pleasures.
If you enjoyed that conversation, make sure to give it a like, and don't forget to check out the rest of the Alternative Series content available on the Livewire Markets website.